How can I make money today? Let's reframe the conversation to consistently lose money in the stock market. Yes, you read that right. If you truly want to profit in the stock market, your first step isn't figuring out how to win, it's understanding how to lose. Today, I'll summarize for you 7 classic ways to lose money in the stock market. A quick guide to losing, distilled from real-world experience. Paid for in blood, sweat, and tears by countless retail investors. Let's see how many of these strategies you've tried yourself. Rule number 1. Relentlessly chase highs and panic sell lows, the undisputed king of money-losing techniques. Its guiding principle, just for words, emotion over reason. How to execute it. You see a stock surge 3 days in a row. Your neighbor just cashed out enough to buy a car. Gives you buy immediately. That's chasing. Result, you buy at the peak just as the price pulls back. You watch helplessly as it tumbles. Is this the top? Is the trend turning bearish? The more you dwell, the more anxious you become. Finally, at a 10% drop, you grit your teeth, cut your losses, and sell euphemistically called a stop loss. Why this works so well for losing? You're not paying for value, you're paying for emotion. Chasing highs means buying when euphoria inflates prices past fundamentals. Selling lows means dumping when fear erases rational judgment heaven. When value is screaming at you, your trades, the perfect counterpart to smart money. When institutions quietly accumulate near the bottom, you watch their lifts and rush in just as they start distributing. When they shake out weak hands, you obediently hand over your chips. You're not trading stocks. You're selflessly delivering warmth and capital to the big funds. Rule number 2. Buy stocks you don't understand. This one's even more lethal. It's like navigating a minefield. Blindfolded. What not understanding means, you don't know what the company does. You're clueless about how it makes money. You haven't a clue about its industry position. So why buy? Gives a guru recommended it as a hot concept stock. The name sounds futuristic. The K-line looks impressive. Why this guarantees losses? Stock investing is betting on a company's future growth. If you don't know what you own, how can you assess if it has a future? When the price wobbles, you have no framework to judge. Gives, is this a normal correction? Gives, or is something truly broken? Every decision floats on castles in the air, driven entirely by market noise. Many chase concept stocks, for example, the primordial metaverse hype. A dozen companies rebrand overnight. Stocks soar, but which ones actually have tech, talent, or real strategy? If you just pick one at random, especially one that only changed its name to jump on the bandwagon, you're not investing. You're volunteering to be the bag holder when the hype fades, leaving nothing but scattered chicken feathers. Rule number 3. Always agree with the crowd. In the stock market, consensus is often a red flag. When everyone believes a stock will keep rising, it usually means the rally's near its end, because all the buyers are already in. What's left? Only selling pressure. Think of a vegetable market. When everyone rushes for the same greens, does the price go down? No, it's peak pricing. Same in stocks. When taxi drivers, neighborhood security guards, and aunties all debate stock picks over food. When unsolicited tips flood chat groups, that's not opportunity. That's maximum frenzy and maximum risk. Rule number 4. Go all in with high leverage margin financing. Want to lose fast? Want to lose everything? Want to experience going to zero overnight? Gives use leverage, margin trading, capital allocation. High ratio financing leverage is a double-edged sword, but for most, it's just the guillotine. Why it's so dangerous? It magnifies risk and shatters your mindset. Example, you invest $100,000 of your own capital. Borrow another $100,000 gives total position $200,000. If the stock rises 10%, gives gain equals $20,000. 20% return on your capital feels amazing. If it drops 10%, gives loss equals $20,000. 20% loss on your capital. Ouch. If it drops 50%, gives your entire $100,000, principal is wiped out. And the broker issues a margin call, forcing you to square your position at the worst possible moment. Leverage doesn't just increase losses, it turns volatility into existential threat.